So here's a topic that I wanted to talk about this week regarding the AI rebound and everything we're seeing from last week's bailout of situational awareness, the Leopold Aschenbrenner Fund, and how that could affect the renewed bullishness around the AI trade. Now, when you zoom out, you start noticing very quickly that the S&P and GDP itself have become essentially the same bet. So what you see in the US economy, what you see in the expansion activity for GDP is essentially the reflection and reflexive feedback loop that is happening within the S&P 500. So today, we're going to cover the engines behind GDP growth, how that affects the stock market, and what could happen in the following months, specifically the second half of 2026, now that the cleansing event from the Aschenbrenner Fund happened as far as the AI trade, leverage, and hedging activity that's happening behind the scenes now. So, first of all, there's a mirror effect happening between the stock market and the economy before, and I would say since 2022, the two were heavily and significantly disconnected. So, whatever the economy did, the stock market did not reflect it. And now it's become clear that the stock market is reflecting the economy and vice versa, though not in the best of ways, because 50% of GDP growth for the first and second quarter of 26 is coming from AI spending into infrastructure, into electrical equipment, computer products, and everything that has to do with the AI supply chain. While 60% of the S&P is now AI related. You have 40% concentration in the top 10 names, which is, of course, the hyperscalers, the NVIDIAs, the chip makers. And then you have an additional 20% concentration into everything that has to do with AI. So semiconductors, memory, cloud computing, and everything else that's going on in the energy sector as well. So the loop happens for the reflexivity that I like to talk about today is that AI capex is going to lift asset prices higher. So that benefits the top 10 to 20% households in the US who keep spending, right? When you see the GDP drivers, consumer spending is a big part of it. But when you break down the consumer spending, it is only the top 10 to 20% households. The bottom 90 to 80% are not doing any spending. So you could see it in stocks like LVMH, you could see it in Rolls Royce, you could see it in Ferrari, you could see it in a lot of these premium brand names. Christian Dior was one of them last week. Chanel reported this week as well, 5% pop on that stock. So meanwhile, you see the bottom brands like Nike, Lululemon, On Holding, and all of those consumer brands not doing well. Why? Because we have a K-shaped economy for the consumer. And the top part of that K is being benefited by rising asset prices, which is called the positive wealth effect. So as long as the AI capex boom continues, inflation is not going to get fixed. Therefore, bond prices may continue to go lower, rising yields, and attempting to slow down the entire excess that is happening. So the third point is the fragility. So if capex slows, it's not only going to bring the GDP growth lower, but it could also wipe out 60% of the S&P's excess. So in other words, when you wipe out capex, and even if you don't wipe out the growth, but you wipe out the expectations, what happens next is asset prices go lower. The top 10 to 20% slow down their spending. That slows down GDP and reprices the S&P valuation lower. Now the signal is not already turning per se, but if we start to see softer GDP prints like last quarter, if we see further names like the hyperscalers starting to slow down the capex due to the debt burdens and interest burdens that they're taking on, then this could start to play out. However, right now it's not really due to the leverage cleansing and the volatility cleansing that we saw from Aschenbrenner. Now, let's get back to GDP. This year's GDP so far, the first half, is coming at 50% from AI spending and 10% from the rest of the economy. So you have roughly 40% of spenders, right? So affluent spenders, the top K of the economy, 50% of AI spending, and 10% in the bottom of the economy. So essentially, the bottom 10% are in a recession. You can see it in names from the consumer defensives to cyclicals to everything else really that is not AI related. So there's two main engines driving the economy right now. One of them, again, AI spending on infrastructure, and secondly, the top K of the spenders, which is essentially the 10 to 20% top households in the U.S. Now that brings a state of fragility to the economy and the stock market as well, because when you zoom in, it is essentially the same trade. So you have, like I mentioned, 40% concentration on the top 10 names, which are essentially technology, 40% concentration further into semiconductor, memory, and energy names that have to do with the powering the GPUs, the circuit boards, and everything that goes into AI. So of course, there's a lot of overlay both in the economy and in the stock market, which is never good. I mean, when you look at past peaks and past capital cycles, they tend to turn when these two signals combine. Now, I'm not saying this is going to happen tomorrow, it's not going to happen this quarter, but it's going to happen soon. It has to happen. We cannot become a manufacturing economy at this point. We are a services economy. We can't rely on this amount of manufacturing at this point. We're not South Korea, guys. So this is unsustainable. So services superpower, as I mentioned, the US is becoming or betting more on manufacturing. So the US economy is essentially a services and consumption economy. This is 80 to 85% of GDP. When you look at the services PMI, it's all their healthcare, software, professional services, finance, and insurance. So, I mean, that is the US economy. It is not electronics, computer equipment, or manufacturing. So, the fact that GDP growth is concentrated more on that latter half is concerning because it is unsustainable. As you know, the manufacturing PMI, it is the cyclical part of the economy. We cannot lean on, we cannot depend on the cyclicality of these industries to drive the economy because what goes up must come down in cyclicals. Now, I want to dig further into the reflexive loop that I was talking about and how the machine keeps feeding itself. So first, we have the AI capex, so trillions at this point being poured into backlogs, into capex spending, into infrastructure, into commitments and everything else. Therefore, expectations for asset prices go up, valuations go up, because everyone thinks that earnings are going to keep coming through and valuations are going to go higher. So it allows for further debt and equity raises to keep spending more into this capex. And that's essentially what we're seeing. Everybody thinks that these backlog commitments are going to come through at 100% without realizing that most of them are concentrated into OpenAI and Anthropic, whose underlying economics are falling through because token prices are now down over 30% on the month. So again, when that happens, nobody knows, but it's essentially a big red flag into those expectations beyond the hyperscalers that are going through in the stock market. Now, when those asset prices rise, because they represent over 60% of the S&P 500, your IRA account, your 401ks, your pensions, everything, the top 10% sees a positive wealth effect because they check in one day, their home price is up because they're building a data center near them. The home price is up because the underlying rental value is up due to inflation from AI spending. When they check their 401ks, they're up 30% in a month. When they check their IRAs, when they check their individual brokerage accounts, everything is up, right? So that creates a positive wealth effect that keeps them spending. The top 10 to 20% households, they keep buying real estate, they keep buying premium luxury products, and that just keeps the economy going, right? So just as this is positive now, it could turn negative. If capex slows, it affects valuations, it affects the wealth effect, goes into a negative wealth effect, and the people stop spending, and it slows down the entire economy. So that is essentially what happens when you run the loop backwards, and where 90% of the growth in the stock market is at risk. Because first, you have the market, right? 60% could reprice lower on falling expectations from the falling capex, right? And then the second point is the consumer. If asset prices go down, if data center spending goes down and construction goes down, real estate prices could come off, both commercial and residential. Because if you own a home, if you own a duplex, triplex, whatever, in an area where a data center is being constructed nearby, that value is going to go up, right? The rental value is going to go up from the utilities going up and everything, right? It affects everything as far as inflation and real assets. So when you see your property value go down, when you see your stock portfolio value go down, you stop spending. So everything starts to reprice lower. And I can't say it enough, right? But I hope I've drilled it enough times today. Now, the infrastructure spend is now double the historical norm, which is concerning, right? Because every single bubble that's come from overinvesting, you look at railroads, you look at electricity, you look at the grid, you look at automobiles, you look at refrigeration, you look at AC, you look at the internet bubble, you look at housing bubble and construction, you look at oil in 2014, you look at beer in 2017. I mean, these are all capital cycles. When you overinvest into infrastructure, what happens is margins start to decline, pricing power starts to decline, and the industry gets very fragmented with a lot of competition. And if we're not seeing that in AI, I don't know where people are at, right? Because we're seeing competition coming through Japan, through Taiwan, through the US itself. And right now, infrastructure spending as a percentage of GDP is up from 0.7% as an average from 2015 to 2022 to more than double now, 1.5% today. So these ratios are still climbing, right? As the hyperscalers keep spending, as everybody keeps spending on the infrastructure and the chip making equipment and everything else, that ratio is only going to go higher. So the acceleration is kind of stalling right now. I mean, this is the last quarter GDP. This is not accounting for the new estimates that are coming through from the hyperscalers and everybody else. But when you look at non-defense investment, which is essentially the AI investment, is down 10% on the quarter. So that's alarming, right? It may have missed expectations or it may have gone down on an accrual accounting basis, but it is down 10%. When you look at the token costs for AI, they're down 30%. So again, that shifts the entire economic structure of the trade. And when you look at the forecast from economists on GDP, they expected 2.1. We got 1.5. So a big miss on GDP because of that decline in non-defense investment. Remember, non-defense investment and spending from the affluent population is what's driving GDP right now. So when you miss on investment, of course, GDP is going to slow down. So the concentration today in the stock market and the economy is bigger than any bubble before it, as I mentioned already. So we had the Nifty 50, we had the 2000 internet bubble, we had the 2007 housing bubble, we had the 2015 energy bubble, and whatever this is today. So the base case is that we must see an orderly rotation back to the real economy. And whatever the sentiment is around manufacturing PMI could drive this. And I wrote about it extensively inside the Offside newsletter for the mid-caps rotation thesis. Some of it's already playing out, and I expect it to accelerate based on this data that we're seeing right now. So right now we have a two-speed consumer, as I mentioned. So roughly the top 20% are doing a 2.1 times the spending above the inflation threshold. So they're spending about 6.5%, 7% year on year compared to inflation, right? So it's keeping the spending threshold above the replacement level, while the bottom 90 to 80% of the economy is spending below. So they're spending like 40% below inflation, which is dangerous, right? Because the biggest companies, the internationals like Walmart, Target, Costco, and all of these defensives are going to see falling sales below inflation, which is essentially bad for the margins, their earnings, and it's just a whole mess for the real economy, right? So every rate path makes one problem worse, because right now the Fed is looking at this inflation data saying, well, it's starting to hurt the real economy names, it's starting to hurt GDP, but it's not showing up yet because they just keep spending, right? The hyperscalers keep spending. The top 20%, the top 10% households, they keep spending. So Kevin Warsh right now is looking at the labor market and saying, well, the real economy it's sort of recovering, right? We see the NFP, we see the PMIs, and it's not looking as weak as he would expect. So he's not focused on price stability, aka inflation. So if they cut interest rates, that helps the bottom 80%, right? It'll help with job creation, it'll help with interest payment burdens for car notes, for rental prices, for everything else. But it also amplifies the top 20% wealth effect. So with more leverage, that would reflate the asset bubble, and that would just be self-defeating, right? Because if they cut rates, they would also help the AI capex spending continue further, right? The financing plumbing behind these loans, these GPU-backed loans, these debt issuance to continue to spend on capex will accelerate at this point, right? So if they cut, it'll help the bottom 20, but it'll also expand on the problem that we already have today. So if they hold or hike, essentially they would stay tight until the excess in GDP and the S&P normalizes through an orderly rotation that I already mentioned. Even if they sacrifice the bottom 80%, that isn't really contributing much. So if you look at the chessboard, I would say the most probable path is that they hold rates and let the bond market do the dirty work for them, essentially, or they hike. And the reason is they have to get the excess GDP spending back in line. They have to get the excess S&P 500 concentration back in line. They can only do this by manipulating interest rates and debt costs, because essentially cheap debt is what's driving the AI capex, which is driving asset valuations, which is driving all the spending, as you know. So again, my probable case is they hold and the bond market continues to increase their yields, or they hike and the bond market does the work for the bottom 80%. Now, volatility, I think it should continue to wake up into the fall because of normal VIX seasonality, right? So we have the S&P, which is a GDP forecast, and essentially what the market is saying is that GDP is going to continue to grow because the second half expectations for capex are going higher. Again, that raises expectations for pretty much 60% of the stock market. So, right, the stock market is now predicting that GDP growth is going to heat up again for the second half of the year. Now, what happens in the second half of the year also, starting roughly in August, October, is the VIX seasonality. So the VIX could start trending higher from here, and essentially it would match the equity level volatility that we're seeing. So the VIX is kind of asleep compared to the individual stock level volatility. And again, this is being helped by the bailouts of the likes of Aschenbrenner. Just like situational awareness, I believe there are a few funds that are facing the same probability of needing a bailout or a rescue. Now, most hedge funds are up for the year, so that's not going to happen anytime soon. So again, the VIX seasonality will depend on how these individual stock volatility measures end up, right? And right now, I did a cover on the AI rebound last night for the Offside newsletter, and it covers the very theme that we're talking about right now, which is volatility. It is compressing, guys, for most of the AI names. So that should increase leverage, that should increase exposure from investors from the institutional, retail, and hedge fund realm. So again, whether we see that VIX seasonality will depend on volatility. For the individual stocks, I don't see that happening right now. Now, the tug of war in the hyperscalers versus semis continues. And right now, the hyperscalers are leading as of Monday, right? Yesterday, we saw the big rebound on the chips and semiconductors and memory names, so everything that is high risk. And essentially, what this is telling me is that the market is going back to a growth at any cost type of mentality, rather than valuing free cash flow, valuing high margins, and valuing the companies that are already monetizing on AI. So they're choosing to bid the companies that tell you we're eventually going to monetize on AI by over-investing, versus the companies that invest responsibly, most of them, right? Microsoft, you have Amazon, Apple, and they're already monetizing on AI. So again, you have a secured balance sheet, a secured stream of cash flow on the hyperscalers, and you have an unsecured balance sheet and a shaky cash flow from the SMH. So essentially, whatever gets bid tells you what the market sentiment is, and right now it is growth at any cost, and they don't value any of the fundamentals and the quality of the financials right now. Now, the verdict here and my base case remains an orderly rotation, not a collapse, right? The collapse comes if we see the financial plumbing breaking, which could come through rising bond yields as they are right now. Now, the concentration will need to deflate. That is the first step. And I think that the excess in the S&P and the excess on GDP need to deflate orderly, right? This is essentially the tug of war between the halo real economy names, the mid caps that I talked about in the newsletter, away from the AI and technology concentration, right? The second handoff would be the consumer. So we need to see the bottom 80% spending pick up. So the likes of the defensives, the Walmarts, the Costco's, they need to start spending above the inflation threshold, which with high inflation is kind of hard, but with the right economic backdrop, I think they could do it. The third pass through would be yields. So they need to stop breaking up, right? And that only happens if expectations around pricing and financial shenanigans stop. And that only stops if we stop the AI capex. So again, all of the high yield credit spreads that are spiking, the credit default swaps that are spiking, all of that has to do with the rates and the yields that are going higher. So we need to stop that, and the only way that we stop it is through AI capex slowdown. Now, if we see a rotation and not a liquidation, I still think the S&P could see a 10-15% drawdown from the highs. If we don't see the orderly rotation, then we could see a proper bear market, so 20% off or more from the highs. It all depends, right? And right now, I think we are in the likes of post LTCM collapse, right? Amaranth collapse in 2007. So the bailout is good news short term, but I think it's bad news long term because it shows you the amount of irresponsibility that is going on, the amount of leverage that is built into the system. Now, you've seen the map, specifically the GDP breakdown and how that affects the stock market. We're not going to see a lot of those effects come in unless we see the plumbing change for the AI financing circle and for the debt issuance out of the hyperscalers. Now, the free framework, right? It is how the GDP affects the stock market and how the stock market affects GDP and how they're a reflexive loop of each other. The concentration consumer risk that we're watching and where the opportunity lies if expectations change down the line. Now, when you come back into the premium side, you're going to have to get the live positioning, right? Because you can't bet this on an ETF. You can't bet this on an individual name that you don't know why it's going to go up, why it's going to go down. That is essentially what we do inside premium. So we give you the type of bonds that we're buying, the price, the long-short equity spread trades, the individual company deep dives, such as the ones we've already sent in software, which are up 30% plus from our buying. So all of this, I think you're going to get 10x the ROI from joining offside. But either way, I'm not trying to sell you anything. I'm just trying to show you a better way of making educated decisions. And either way, you can get 7 days free right now. We have a limited offer on that. So come check us out. If we don't deliver what we're promising, then cancel anytime, right? Now that's all for today, guys. We are getting services PMI here in a little bit. We just got manufacturing on Monday, so I'm going to break down both reports and give you the industry screening as far as where I'm looking to get the next swing opportunity for these trades. Now, I'll catch you guys in the next one. Good luck.